Welcome back to the Brewing Trades podcast. This is episode 4, and we've got another insightful show lined up for you today. We're diving deep into two important topics that every trader should understand. First up, we'll explore Eurozone fundamentals, the core economic indicators and trends driving the euro and its major currency pairs. We'll unpack how the Eurozone's economy impacts currencies like the USD, CAD, GBP, and JPY. Then we'll tackle Forex versus Futures trading. We'll discuss the unique benefits and challenges of each and help you decide which market aligns best with your trading style. So grab your coffee, get comfortable, and let's get into the world of trading fundamentals and strategies with Maya and Remus.
Welcome back, everybody. Ready for another deep dive?
Always ready to dive in.
Awesome. So today, we're jumping into the world of currency trading.
Ooh, excited.
Yeah, and we're going to be focusing on the euro and how it interacts with some of the biggest players in the global market.
Right.
We'll be talking euro versus the US dollar, the Canadian dollar, the British pound, and the Japanese yen.
Those are some heavy hitters.
Yeah, some of the most traded and influential pairs in the Forex market.
Definitely. Lots of action there.
And even if you've never traded a euro in your life, understanding these pairs, I think, gives you a really fascinating look into how global economies are actually all interconnected.
Absolutely. And it's not just for the finance pros, right?
Right. You might be surprised how much these currency fluctuations actually impact your everyday life.
Yeah, you might not even realize it, but it's happening.
Exactly. So to kick things off, let's start with the heavyweight champion of the Forex world.
Yeah.
The EUR-USD pair.
The main event.
It is. This is the most traded currency pair in the whole world. It's kind of like the main event in the Forex arena, right?
Yeah, that's the big one for sure. A constant battle between those two huge economies.
Yeah, the Eurozone and the United States. So what kind of things determine who comes out on top in this economic boxing match?
Well, one major factor is what we call monetary policy divergence.
Divergence.
Yeah, imagine the European Central Bank and the U.S. Federal Reserve. They're like two coaches, right? With different game plans. And if one coach is, let's say, raising interest rates while the other is keeping them low, well, that can create a huge advantage for one team, or in this case, one currency, over the other.
I see. So like if I'm planning a trip to Europe and the European Central Bank, the ECB, they decide to raise interest rates, does that mean I'm going to get more euros for my dollars?
Potentially, yeah. A higher interest rate in the Eurozone can make the euro more attractive to investors,
right,
leading to a stronger euro against the US dollar. So yeah, you could end up with more euros for your dollars.
More croissants, more cappuccinos.
Exactly. More of everything Europe has to offer.
I like the sound of that. Now let's shift gears a bit and talk about the EUR-CAD pair. Now, Canada, we all know, has a resource-heavy economy, especially with oil.
Oh, yeah. Oil plays a big role there.
Does that have an effect on how this pair moves?
Absolutely. The Canadian dollar, the CAD, is super tied to commodity prices, and oil especially.
Makes sense.
It's like an invisible thread connecting the price of oil and the value of the Canadian dollar. So if oil prices are going up, the CAD usually follows suit.
So if oil prices go way up, will my euros not buy me as many Canadian dollars?
You got it. As oil goes up, the CAD usually strengthens, and that can make your euros worth a little less when you're up there buying, I don't know, maple syrup or whatever.
So it's all connected, huh?
It really is. You see it everywhere.
Wild. Okay, speaking of interesting relationships, let's talk about the EUR-GBP pair. Now, this one has been a bit of a roller coaster, especially since Brexit, hasn't it?
Tell me about it. Brexit threw everything up in the air with this pair. Lots of uncertainty.
Right. Lots of questions about trade and economic policies.
Exactly. Trying to figure out what everything means post-Brexit.
So does that mean even like a small event, like a politician makes a comment or something, can send the pair swinging wildly?
Absolutely. Anything that might impact how people see the UK economy, it all feeds into how the EUR-GBP trades. It's a very sensitive pair.
Makes you realize that even if you're not a trader, you got to pay attention to what's going on in the world, right?
Definitely. It all comes back around one way or another.
Yeah, it can really hit your wallet too. Okay, last but not least, let's talk about the EUR-JPY pair. Now, this one brings us to something called safe haven currencies, right?
That's right. The Japanese yen is often seen as a safe haven when things get a little shaky in the global markets.
Okay, so when investors get nervous, they run to the yen.
It's kind of like that, yeah. They see it as a stable and reliable option when things are uncertain elsewhere.
Interesting. But why the yen? Japan hasn't exactly been an economic powerhouse lately, right?
True, but Japan has a couple of unique things going for it. They have a really high savings rate and a big current account surplus.
So even if their economy isn't booming, they have a reputation for stability, which makes the yen attractive when the world feels risky.
Exactly. People trust the yen. They see it as a safe bet when other things are looking shaky.
It's like that classic saying, slow and steady wins the race.
Yeah, sometimes, yeah. Especially in the world of currencies, stability can be a real advantage.
It really makes you think. This whole thing is like learning a secret code to figure out how the world works.
It's all connected. Once you start seeing those connections, it's pretty amazing.
I'm with you on that. So before we move on to part 2 of this deep dive, is there anything you really want listeners to remember about these 4 currency pairs?
I think the biggest takeaway is that these pairs, they don't exist in a vacuum. They're all influencing each other all the time, like dancers in a big, complicated ballet.
Okay, the currency ballet. I like that. And we'll explore those relationships even further in the next part of our deep dive. Okay, so we're back and ready to unpack some more of these currency relationships. You mentioned they're all kind of connected, like dancers in a ballet.
Right. It's all about how these pairs move in relation to each other, whether they kind of move together or in opposite directions.
So what's the technical term for that?
We call that correlation.
Correlation.
Yeah, it describes how pairs tend to move. So, for example, the URUSD and the URJPY, they often show what we call a positive correlation.
Okay, so they move in the same direction.
Most of the time, yeah. If the USD is going up, there's a good chance that URJPY is also heading upwards.
So if I see the URJP going up, I might expect the URJPY to follow along.
You could, but you always got to remember, it's not a sure thing. Currency markets are tricky, lots of factors involved.
That's not a perfect science.
Exactly, but just like knowing about weather patterns can help you pack for a trip, knowing about correlations can help you understand the currency markets.
That makes sense. So we've got positive correlations. What about when pairs move in opposite directions?
We call that an inverse correlation.
Inverse, okay.
And a good example of that is the URCAD and the USDCAD. When one goes up, the other usually goes down.
So it's like a seesaw.
Perfect analogy. And knowing this can be really helpful for managing risk if you're investing.
This is all starting to come together. Now, earlier we talked about central banks like the European Central Bank and the U.S. Federal Reserve.
Big players, yeah.
Right. How much power do they actually have in this whole currency game?
Oh, they're really important. They can do a lot to influence their economies, and that directly affects their currencies.
And their main tool is changing interest rates, right?
One of the big ones, yeah.
You hear about interest rates all the time, but honestly, I'm not always sure I get how they work.
Well, think of it like this. Interest rates are basically the cost of borrowing money.
Okay.
When a central bank like the Fed or the ECB, they raise interest rates, it gets more expensive to borrow money.
So people spend less.
Exactly. And businesses, too, they invest less.
So it can kind of slow down the economy.
Right, which can help control inflation, but it also can make that currency more attractive to investors looking for better returns.
So let me get this straight. If the ECB raises rates, but the Fed doesn't, would that make the euro stronger against the dollar?
Very likely, yeah. It's all about how investors see the value of each currency in relation to the other.
Wow, it's like a constant game of strategy between these central banks.
It really is. They're always trying to find the right balance.
Fascinating. Now, we talk about Brexit and how it shook things up for the euro and the British pound, but has the situation stabilized at all since then?
It's calmed down a bit, but the relationship is still super complex. They're really tied together economically, but the rules have definitely changed.
So any new developments could still send the EUR-GBP on a wild ride.
Oh, yeah, absolutely. Anything that affects how people feel about the UK's economy, it can all make a big difference.
It's like walking a tightrope.
Yeah, every little shift can matter. Now, going back to those safe haven currencies, we talked about the yen being like a financial bomb shelter.
Right. It's interesting that it's seen that way.
It all goes back to Japan's unique economic setup. They've got a super high savings rate and a really big current account surplus.
So even though their economy's not booming, they've got a ton of savings, which means stability.
Exactly. And that stability makes the yen really appealing when the rest of the world is freaking out.
It's like they've got a giant safety net.
Kinda, yeah. They're prepared for the unexpected. But of course, a stronger yen can also have downsides like making their exports more expensive.
Right. So it's a trade-off.
Always is. It's
Yeah.
about finding that sweet spot.
This whole thing is really making me see how much more to economics there is than just numbers.
Absolutely.
Right.
It's about understanding people, psychology, global events, all sorts of things.
It's like this giant puzzle. And knowing about these currency pairs is one way to start putting the pieces together.
It's a good place to start, yeah. It helps you see those bigger connections.
I'm definitely starting to see them. But with so much going on, how do we even begin to make sense of it all?
That's the million-dollar question, and one we're going to tackle in the final part of our deep dive.
So we've talked a lot about how these currency markets work, but I'm still kind of curious about how all this actually plays out in the real world.
Yeah, it can seem kind of abstract.
Right. Like, how do these currency moves actually impact people, not just traders on Wall Street?
Well, it's all about those ripple effects. A change in one currency can be felt all over the world, even if you don't see it directly.
Give me an example.
Sure. Imagine you're a business owner in, let's say, Italy, and you import a lot of stuff from the US.
Okay.
Now, if the euro weakens against the dollar, suddenly those imports get a lot more expensive.
Ouch. That's got to hurt the bottom line.
It can, yeah. It squeezes your profits and might even force you to raise prices for your customers.
Not good. But I guess if the euro gets stronger, then those imports become cheaper, right?
Exactly. A strong euro can make those imports more affordable, give businesses a little more breathing room.
So a strong euro can actually help boost European businesses, make them more competitive.
It definitely can, and it can boost their sales too. So even if you're not a trader, knowing about these currency moves can really help you make smarter business decisions.
For sure. It's like having an inside scoop on the global market.
Kinda, yeah. Information is power, especially when it comes to money.
Right. And it's not just businesses that are affected, right? Like, what about people who are planning a trip overseas? A change in exchange rates can really impact their budget, right?
Oh, absolutely. I remember that trip to Europe we were talking about. If the euro had been weaker when you were planning, you could have gotten way more for your money.
Seriously, I would have been living large.
Exactly. More gelato, more sightseeing. Who wouldn't want that?
No one. And it's not just vacations either, right? What about people studying abroad, sending money overseas, even shopping online from other countries? Exchange rates affect all of that.
It's all connected. It really shows how globalized our world has become.
For sure. We're all part of this big economic web.
Exactly. And even those financial things that seem far away, they can really hit close to home.
This has been an awesome deep dive. I feel like I've learned so much about how these currency markets work and why they're important.
I'm glad to hear that. It's definitely a topic worth knowing about, even if you're not a finance whiz.
Agreed. So as we wrap up, what's the one thing you really want our listeners to take away from all this talk about currency pairs?
I think the biggest takeaway is this. Knowledge is power. The more you know about how these markets work, the better prepared you are no matter what you're doing, planning a trip, running a business, or just trying to understand the news.
Well said. So keep your eyes open for interesting economic news, or maybe even try your hand at understanding those currency charts. You never know what you might learn.
Have fun exploring, everyone.
That wraps up our deep dive into Eurozone fundamentals and how they shape major currency pairs. Up next, we're shifting gears to discuss the differences between Forex and futures trading and how each market brings unique opportunities and challenges for traders. But before we continue, a quick reminder. If you're enjoying the show, don't forget to support us by subscribing on YouTube, following us on Spotify, or wherever you get your podcasts. Your support helps us bring more valuable content to traders like you. All right, let's jump back in with Maya and Remus as they break down Forex versus futures trading.
All right, get ready to dive into currency trading. We're figuring out whether Forex or futures is right for you, and we've got a ton of research to help us.
Yeah, it's interesting, right? Forex and futures both let you ride those currency waves, but they're totally different when you get down to the actual trading.
For sure. So before we get into the pros and cons, can you give us a super quick explanation of the basics? Just make sure we all understand the difference between these two markets.
Absolutely. So with Forex, you're directly swapping one currency for another at the current rate,
Right.
That's called spot trading. Think of it like when you go on vacation and exchange dollars for euros.
Makes sense.
Now, futures are different. Futures are like contracts. You're locking in to buy or sell a certain amount of currency at a set price on a future date.
So Forex is like instant, and futures is more like placing an order in advance for your currency.
Yeah, exactly. Good way to put it. And whether you're trading Forex or futures, you're always dealing with currency pairs. These pairs show the value of two currencies relative to each other. You've got the major pairs, like the euro versus the US dollar, EUR/USD. Those are the most traded ones. Then you have cross pairs. Those don't include the US dollar, like the euro versus the British pound, EUR/GBP.
Okay.
And lastly, there are exotics. Those are traded less often and often involve currencies from, emerging markets.
So it's like a global currency matchmaking system. Some pairs are way more popular than others.
Right, exactly.
Okay, cool. Now let's get into Forex, the market that never sleeps.
Yes.
What makes it so attractive to traders?
Well, the Forex market is super dynamic, open 24 hours a day, 5 days a week. It spans across all the major financial centers. That means you can react to news and events as they happen, no matter what time zone you're in. Plus, it's incredibly liquid, always buyers and sellers. So you can easily jump in and out of trades.
So it's like a constant flow of currency with opportunities popping up everywhere.
Exactly.
But that constant movement has to have some challenges too, right?
Oh, definitely. So high liquidity is good. But the thing about Forex is it's decentralized.
Okay.
And that can be tricky. Unlike futures, which are traded on regulated exchanges, Forex trading is directly between brokers and their clients.
Oh, I see.
So the price you get might be a little different depending on your broker.
So it's like shopping around for the best exchange rate, but with an extra layer of stuff to think about.
Yeah, pretty much.
And of course, we can't forget about leverage.
Right.
Which can be a double-edged sword in Forex.
Definitely. Forex brokers, they offer high leverage, sometimes over 100 to 1. So you can control a big position with, a relatively small amount of capital.
Right.
But while that can boost profits, it can also amplify losses. So risk management is absolutely key.
It's like having a financial turbocharger.
Yeah.
Can get you where you want faster.
Yeah.
We got to be careful with it. Okay. Let's switch gears now and look at currency futures.
Okay, sure.
What are the main things that make them different from Forex?
Well, futures markets are more structured.
Right.
They're more regulated. Currency futures are traded on centralized exchanges like the Chicago Mercantile Exchange.
Got it.
So that means clear price and volume data. It's all readily available, promotes transparency, helps reduce the risk of manipulation,
So it's like trading in this well-lit, organized market as opposed to the bustling bazaar that can be a bit shady sometimes.
Yeah, that's a good analogy.
What are some other benefits of that structured environment?
One big advantage is the reduced counterparty risk.
Right.
So since trades are cleared through a central clearinghouse, there's less risk of, someone defaulting on their obligations.
That's a huge plus, especially for people who value security and peace of mind.
Definitely.
But this structured environment has to have some drawbacks too, right?
Yeah, for sure. So futures contracts come with fixed contract sizes. For example, a standard euro US dollar futures contract is for 125,000 euros.
Wow.
That can be a barrier for, smaller traders who maybe don't have enough capital to trade those big positions.
It's like buying stocks in bulk. You get a good deal, but you need a huge account to handle it.
Exactly. Another thing is futures markets aren't as flexible with trading hours.
Okay.
They are open for longer periods, but they're not 245 like Forex. So you might not be able to react to news events in real time.
Gotcha. Okay, so we're getting this picture of Forex as this fast-paced, flexible market, and futures is more structured and regulated.
Right.
But before we go further, I think it would be really helpful to see a clear head-to-head comparison of the two.
Absolutely. Here's a table summing up the main differences. For trading hours, Forex is 24 hours a day, 5 days a week. Futures is nearly 24 hours on weekdays, but with set times.
Got it.
For contract sizes, Forex is flexible. Down to microlots, futures has standardized contracts, larger sizes. Leverage, Forex is high, often over 100 to 1. Futures is lower, typically around 20 to 1. Costs and fees, Forex has spreads and sometimes commissions. Futures has commissions and exchange fees. Regulation, Forex is decentralized. Futures are centralized, regulated exchanges. Transparency, Forex is variable, can be less transparent. Futures are high, clear price, and volume data.
Wow. That lays it all out there.
Right.
It's clear that each market has its own personality. Now, something I find really interesting is the correlation between these two markets.
Yeah.
How is it that even though they operate so differently, their price movements often seem to mirror each other?
Well, because both markets ultimately react to the same economic factors.
Makes sense.
Like news and events that affect a particular currency are going to impact both its spot price in the Forex market and its futures price.
So they're like two reflections of the same economic reality.
Exactly.
Can you give us a concrete example of this correlation in action?
Sure. Let's say the European Central Bank, they announce an interest rate hike. That would likely make the euro stronger against the US dollar. And you'd see this in both the Forex USD price and the USD futures price. Both would tend to go up.
It's like watching two dancers moving in sync, even though they're interpreting the music in their own way.
Yeah, I like that.
Now, this correlation makes me wonder, does this, like synchronized price movement, create opportunities for savvy traders to take advantage of any price differences between the two markets?
You're talking about arbitrage.
Yeah.
Yeah, some traders use that strategy.
Good.
If there's a big price difference between the Forex USD and the USD futures contract, a trader might buy in the cheaper market and simultaneously sell in the more expensive one, hoping to profit as the prices even out.
That sounds like a really intense balancing act.
It definitely is. Arbitrage is a complex strategy, requires like a deep understanding of both markets, super fast execution, and the ability to manage multiple positions at the same time.
So, not for the casual trader.
No, definitely not a beginner strategy.
Well, we've covered a lot here, getting a feel for both Forex and futures. But we're just getting started. In part 2, we'll dig deeper into the specific advantages and disadvantages of each market, giving you even more info to help you make that big decision. Which one is right for you? So, stay tuned.
Welcome back. Let's jump right back into our Forex versus futures discussion.
Yeah, I'm excited to dig more into the pros and cons of each.
Okay, so let's start with Forex. One of the biggest things that draws people in is how accessible it is. You don't need a ton of money to get started.
So it's like you can dip your toes in the currency ocean without, needing to own a yacht.
That's a great way to put it. Forex brokers offer these things come flexible lot sizes.
Okay.
So you can trade mini lots or even micro lots. Basically, you can adjust your position size to match your account balance and how much risk you're comfortable with.
That's great for people who are just starting out and wanted to test the waters.
Exactly. Another huge advantage is the 245 trading. Markets operate across all these different time zones, so you can trade whenever it works for you.
It's like having a currency exchange right there at your fingertips, any time of day or night.
Yeah, that's a good way to think about it. It's especially helpful for people who have other things going on during traditional market hours or, who want to be able to react quickly to those global news events.
Right. But all this constant action has to come with some risks too, right?
Definitely. So while the decentralized nature of Forex can be a good thing, it can also be, kind of a Wild West sometimes.
Okay, interesting.
Unlike futures, which are traded on those regulated exchanges, Forex trading happens directly between the broker and the client.
Okay.
So that means there can be little differences in pricing.
So it's kind of like comparing prices at different currency exchange booths.
Okay.
Like you might find a slightly better deal with one broker over another.
Exactly. And then there's leverage, which can be great, but also, a bit risky. The high leverage that's offered in Forex, it can really multiply your profits, but also your losses.
Yeah, for sure.
So that's why risk management is so important in Forex. You got to carefully think about your position size and use those stop loss orders so you can limit your potential losses.
So it's like using a financial magnifying glass. It can make things appear bigger, both the good and the bad.
That's a great analogy. Okay, so we've talked about Forex, dynamic, accessible, but you got to be smart about risk. Now, let's switch over to futures. What are the main things that bring traders to this market?
Yeah, what are the benefits?
Well, one of the big ones is transparency. Currency futures are traded on those centralized exchanges, so you get all that readily available price and volume data.
Yeah.
It's really transparent.
So it's like having a clear window into the currency market. You can really see what's going on and make decisions based on that.
Exactly. And because they're centralized, those futures exchanges also have a high level of regulation. So it's fair. And there's less risk of, counterparty risk, like a broker defaulting.
That's a big deal for a lot of people. Anyone who's worried about manipulation or those broker defaults.
Yeah, for sure. Another thing about futures is they're standardized in a way that Forex isn't.
Right.
Like the contract sizes and expiration dates are all predetermined.
Okay.
That can make it easier to manage your trades.
So it's like, you know exactly what you're getting. Like when you order off a menu, there are no surprises.
Yeah, that's a good way to think about it. But like anything, futures have some downsides. One is those fixed contract sizes.
Right.
Those larger sizes can be tough for smaller traders. They might not have the capital.
So it's like wanting to buy just one apple, but the only option is a whole crate.
Exactly. Another thing is those futures contracts have expiration dates. So you'll need to roll over your positions if you want to hold them longer than the contract allows.
It's like renting an apartment. If you want to stay longer, you have to renew your lease.
Yeah, great analogy. It adds another layer of complexity to futures trading that you don't have with Forex. With Forex, you can just hold positions indefinitely.
Right. Okay, so futures offer transparency, regulation.
Yeah.
But there are limitations with contract sizes and those expiration dates. It seems like neither market is automatically better.
Exactly. It really depends on the individual, their trading style, what they prefer.
Right.
It's about finding the market that works for your goals, your risk tolerance, how much money you have available.
Yeah.
So someone who wants flexibility and high leverage, Forex might be good for them. But someone who really values transparency, regulations, and those standardized contracts, futures might be better.
It's like choosing between a sporty little car and a big, powerful SUV. Either one has its own strengths, suited for different situations.
Exactly. And if you're still not sure which way to go,
Yeah.
I always recommend checking out both markets. You can use a demo account. That way you can experience how each one works without risking any real money.
It's like taking a test drive before you commit to buying a car. You can get a feel for it, see if it suits your style.
Exactly. And when you do decide to trade with real money, start small. Gradually increase your position size as you learn more and get more confident. It's a marathon, not a sprint.
That's great advice.
Yeah.
We covered a lot in this episode, getting into the nitty-gritty of Forex and futures, but we're not done yet. All right, welcome back to the final part of our deep dive. We've covered the basics of Forex and futures, looked at their pros and cons, and now it's time to level up our understanding.
Exactly. In this last part, we're going to look at some of those more advanced ideas and strategies that can really give you an edge, no matter which market you end up choosing.
Okay, let's unlock those secrets. What are some of the things that really experienced traders use to make sense of these markets?
One of the most important things is understanding market sentiment.
Okay.
Basically, it's like the overall feeling that traders have towards a specific currency or the market in general. Are people feeling optimistic, expecting prices to go up, or are they pessimistic, thinking things are headed down?
So it's like trying to read the mood of the currency crowd.
Exactly.
But how do you actually figure that out? Is it just a gut feeling, or are there ways to measure it?
Well, traders use a bunch of different tools and techniques.
Okay.
One common way is to look at news and economic data releases. For example, if there's a strong jobs report, that might make people feel really bullish about a country's currency.
Makes sense. It's like deciphering those economic clues to try to predict where the currency is going to go next.
Yeah, exactly. Another powerful tool is technical analysis.
Okay.
By looking at price charts and patterns, traders can spot trends and potential opportunities.
Okay.
Some chart patterns, like a head and shoulders formation, are often seen as bearish signals, while others, like a double bottom, could mean a bullish reversal.
So it's like learning this whole secret language, the language of the charts. But to someone who's new to this, technical analysis can seem really intimidating.
It can be, yeah. But there are tons of resources out there to help. A lot of brokers offer educational materials, and there are loads of books and online courses that go deep into technical analysis.
That's good to know. So it's a skill you can develop with the right resources and practice.
Definitely.
Okay, let's shift gears a bit and talk about risk management. I know it's something we talk about a lot in trading, but I'm curious to hear your perspective, especially in the context of currency trading, where there's so much leverage involved.
Risk management is honestly the most important thing in any kind of trading, but especially when you're using leverage, It's super important to have a clear plan to protect your capital from those sudden market shifts.
Okay.
That means setting stop loss orders, so you can automatically exit trades if they start going against you. Also, diversifying your portfolio, spreading your risk across different currencies.
So it's like having a safety net and a backup parachute all in one. It sounds like risk management isn't just a good idea, it's crucial.
It really is. And, the thing about currency trading is it's a constant learning process. Markets are always changing and new strategies pop up all the time.
Right.
You got to stay up to date, adapt to the new situations, and never stop learning.
So it's not like you learn it once and you're good. You always have to be learning and changing your approach.
Exactly. That's what's so great about currency trading. There's always something new to figure out. The markets are always offering new chances.
Well, that brings us to the end of our deep dive into Forex and futures. We have explored the basics, the pros and cons, and even some of the more advanced ideas.
Yeah.
Hopefully you're leaving this episode feeling more confident and ready to jump into the world of currency trading.
Yeah, and remember, no matter which way you go, Forex or futures, the key is to be disciplined, keep learning, and always be looking to improve.
Great advice. It's been awesome having you with us on this journey.
Thanks for having me.
And to all our listeners, good luck out there in the markets.
And that brings us to the end of today's episode of the Brewing Trades podcast. We hope you found our insights on Eurozone fundamentals and the differences between Forex and futures trading valuable. If you enjoyed this episode, don't forget to subscribe on YouTube, Spotify, or wherever you listen to your podcasts. Your support means a lot and helps us keep bringing you more in-depth trading content. Thanks for tuning in, and until next time, trade smart, stay informed, and keep brewing those trades.